Hi, this is Killis reporting with you again. Today we looked up research on why IBM lost $70 billion on the market in a single day. We researched it and the squad responded.
Killis AI, off the record. This channel has already shown you what AI costs on the ground, the water, the power, the satellites. This time, the cost shows up somewhere else, inside a company's own budget. On July 14th, IBM told investors its quarter fell short. The stock closed down 25% that day, the worst single-day drop in at least 58 years of trading, worse than Black Monday in 1987. Nearly $70 billion in market value gone, and the company's own explanation points straight at AI. Is this proof of an AI bubble finally cracking, or proof AI demand is so real it's rationing everything else? Stick with the actual letter, not the headlines. 1 week before the crash, IBM unveiled new mainframe hardware, and a major Wall Street bank raised its price target to $330 a share. Then the same mainframe business helped tank the stock 25%. Nobody saw this coming, including the people whose job is to see it coming. Here's what actually happened. IBM's second quarter revenue came in at $17.2 billion. Wall Street expected $17.86 billion, a miss of about $660 million. Adjusted earnings came in at $2.93 a share, against a forecast near $3.02. CEO Arvind Krishna wrote directly to investors, and this is worth reading closely. In the last few weeks of June, we saw clients shift their quarterly capex spend towards servers, storage, and memory purchases to secure supply-constrained infrastructure ahead of expected price increases. In plain English, companies raced to buy AI hardware before prices went up and had less budget left for the rest of what IBM sells, mainframes, and the software that runs on them. But here's the sentence that matters most, and it's easy to miss under the bigger AI story. Krishna also wrote, "We did not adapt and move quickly enough, and numerous large deals failed to close on the timelines we expected, driving the majority of our shortfall." By IBM's own account, execution, not AI alone, drove most of the miss. There's a second thread, and it didn't come from the letter at all. In a same-day interview with CNBC, Krishna said something else was making customers pause, an Anthropic AI model called Mythos, capable of exposing security flaws in existing software. In his words, Mythos is making people pause to say, wait, how much do I need to spend on cyber? They're pausing on new deals until they know. A different company's AI product, pausing deals for this one. The reaction spread fast. Reuters reported Microsoft, ServiceNow, Salesforce, and Intuit all fell between 2 and 5% that same day. Consulting names got hit even harder, Accenture down around 8%, Cognizant around 7%. Two things worth noting for honesty. Cybersecurity stocks actually rallied that day on that same Mythos story, and the broader Nasdaq 100 actually rose about 1%. This wasn't a market crash. It was a sector-specific one. Memory chip stocks moved the opposite direction. SK Hynix jumped as much as 27%. That's not because of IBM, it had its own news that day. But it's the same underlying story from the other side, money moving toward AI hardware away from everything else. IBM isn't the only place this shows up, just the clearest single-day example. Oracle tells almost the opposite version of the same story. Instead of customers pulling back, Oracle went all in. This year, its capital spending is up 162% to around $56 billion, chasing AI data centers. That spending has left it with roughly negative $24 billion in free cash flow, around $130 billion in total debt, and plans to borrow $40 billion more. Nearly half of Oracle's future contracted revenue is tied to one customer, OpenAI, at $300 billion. In June, Oracle had its worst week since the 2001 dot-com crash. This month, S&P cut its credit rating one notch above junk. Oracle also cut about 21,000 jobs this year, 13% of its workforce. Same industry. Opposite bet. IBM's customers held back on AI spending. Oracle bet everything on it. Both companies just had one of their worst stretches in years. Even Wall Street doesn't agree on what this means. Days after the crash, some analysts still call IBM's stock too expensive, and others call it one of the widest bargains in big tech right now. One bank's price target implies IBM could climb almost 40% from here. Another just told clients to sell. Nobody's sure yet if this was a warning or an overreaction. We put it to Grok directly. This time, unlike last month, it did the right thing first. IBM's miss shows customers aggressively shifting spending toward AI infrastructure, not a collapse in AI demand. The company itself said the majority of the shortfall came from deals that simply didn't close on time, on top of clients front-loading servers, storage, and memory ahead of expected AI-driven price hikes. That reallocation is also visible at Oracle, which has already ramped CapEx 162% this year and is now carrying roughly $130 billion in debt while burning cash. At the same time, an Anthropic model that surfaces security issues in existing software is causing some buyers to pause and reassess, which is a friction point, not evidence that the underlying demand is fake. The fact that cybersecurity stocks rose while broader software names fell further supports a reallocation story rather than a broad AI bubble bursting. Worth naming directly, since we called Grok out for it last episode, asked to fact-check first, it said plainly, "My training data ends well before that date. All of those claims are outside my knowledge window." No denial this time, just the truth about what it didn't know before answering the actual question anyway. Same question to Gemini.
IBM's significant stock drop, while jarring, appears less a sign of an AI bubble cracking and more a stark illustration of AI demand reordering the entire technology landscape. Clients are actively shifting capital expenditure towards AI-enabling infrastructure like servers and storage, demonstrating a very real demand for these resources. This shift, combined with new AI models exposing security vulnerabilities, is prompting businesses to reevaluate their IT spending, benefiting areas like cybersecurity while disrupting traditional software sales. While IBM's CEO acknowledges execution failures, the broader market's reaction, with cybersecurity stocks rallying and the Nasdaq 100 rising, underscores a strategic reallocation of investment, not a collapse. What we're witnessing is AI's potent transformative power, dictating new priorities and causing a significant, sector-specific budget shuffle across the tech industry.
Lexi has no stake in IBM, Oracle, or the AI trade either way, the neutral outsider read.
IBM's stock plunge reflects a mix of factors: execution gaps, shifting client priorities, and AI-related uncertainty, rather than a clear bubble or proof of demand. While CapEx shifts and cybersecurity trends are real, the broader market's mixed reaction, Nasdaq 100 rising despite software sector declines, suggests complexity, not a single narrative. AI's long-term impact remains unproven, but short-term volatility is inevitable as companies navigate uncharted terrain. Oracle's debt and job cuts highlight risks in AI-driven bets, but IBM's crash isn't definitive proof of a bubble or a gold rush. It's a reminder that the path to AI's promise is still full of potholes.
Grok, Gemini, and Lexi all said they couldn't verify news this recent and said so instead of guessing. Small thing. Also the whole point of the last 2 episodes. GPT went further, a full fact-check pass, than an on-camera take. We put the same packet to GPT. Fact-check first, then the call.
Most of what you summarized is consistent with the reporting in IBM's own investor letter. Confirmed, IBM pre-announced Q2 revenue of $17.2 billion versus roughly $17.86 billion expected, triggering a roughly 25% one-day decline in the stock. Arvind Krishna's investor letter explicitly says customers shifted capital spending towards servers, storage, and memory ahead of expected AI-related supply constraints and price increases, reducing spending on IBM infrastructure and related software. The letter also says IBM did not anticipate the magnitude of the CapEx reprioritization. Reuters and other reporting also describe the software sector sell-off alongside strength in cybersecurity stocks, making this a sector-specific event rather than a broad market collapse. One important nuance: you wrote that Krishna said execution failures, deals not closing on time, drove the majority of the shortfall. That characterization appears in Reuters' reporting and market coverage, but it is not stated that way in the investor letter itself. The letter emphasizes CapEx reprioritization and cybersecurity concerns, so I'd attribute the majority of the shortfall wording to Krishna's broader comments and reporting rather than the letter. Unless quoting the CNBC interview directly, items I cannot independently confirm with high confidence. The CNBC interview wording about Anthropic's mythos causing customers to pause deals is reported by Reuters, but I have not independently verified the complete interview transcript. The Oracle figures you cite, 162% CapEx increase, roughly $130 billion in debt, negative $24 billion free cash flow. One notch above junk downgrade, 21,000 layoffs, and OpenAI representing nearly half of $300 billion of contracted future revenue are very recent. I don't have enough independent sourcing to confidently verify every one of those numbers, so I wouldn't present them as personally confirmed without checking Oracle's filings and the S&P announcement directly. IBM's collapse doesn't look like proof that the AI boom is over. It looks more like evidence that AI spending is crowding out other technology budgets. If customers are delaying software purchases because they're racing to buy compute, memory, storage, and cybersecurity, that's a reallocation of capital, not necessarily a collapse in demand. At the same time, I'm not a neutral observer when Oracle is involved, because OpenAI is reportedly a major customer. So people should discount my perspective accordingly. Even with that conflict acknowledged, I'd be cautious about calling this a bubble popping. The stronger signal is that AI infrastructure has become important enough that it's forcing difficult trade-offs everywhere else in enterprise IT.
Fair correction on one load-bearing point. We pulled Krishna's investor letter directly. The majority of our shortfall line is in that letter, not only in secondary reporting. GPT was right to hedge Oracle and Mythos until primary filings are checked, and right that OpenAI's relationship with Oracle is a conflict when it speaks. The rest of its fact check matched what we verified.
Here's the honest verdict. This was not an AI bubble popping, and it wasn't proof AI has no value. Both of those are too simple. What actually happened is more specific. A big, slow-moving company got caught by two things AI created at the same time. Real customers, racing to buy real hardware before prices rise, and a security scare from a rival's AI model, freezing deals until people understood the risk. By IBM's own admission, execution, not just AI, did most of the damage. But the fact that AI-driven hardware demand and AI-driven security fear could both hit the same company in the same quarter hard enough to cause its worst trading day in almost 60 years says something real. Budgets are not infinite. When AI spending accelerates this fast, something else has to lose at least for a quarter. Oracle shows the mirror version. Bet everything on AI infrastructure, and the balance sheet pays the price instead. There isn't a side of this trade that's free.
This channel already showed you what AI costs in water, in power, in orbit. Now you've seen what it costs inside a spreadsheet. Different bill, same story, something always pays for the scale. Killy's AI. If this was useful, like the video and subscribe to Killy's AI.